All right, let's get to the Fed and interest rates. CNBC co-anchor of Squawk on the Street, Morgan Brennan, joining me now. Morgan, no rate change today, but Fed Chair Jerome Powell said this just a couple of minutes ago after the Fed wrapped up its two-day meeting. Take a listen.
In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer-run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate.
So what else did Powell say about the Fed's hot plans for 2022?
Hot plans is the right way to put this, Allison. That press conference with the Fed chair, it's still ongoing. You're right. No change to rates from the policy meeting today, but the Federal Reserve is signaling that a rate hike could come as soon as March. This is, to put it in context, a big reversal from the Fed's stance as recently as September, when policymakers still believed that inflation would be, quote unquote, transitory in 2021. So here's the good news. Very strong labor market, strong economy. This is what Chair Powell is really speaking up in this press conference. You got wages rising at their fastest pace in years. And he believes there are, in addition to policy moves being laid out by the Fed, other forces this year that are going to help bring down inflation. For example, supply chain bottlenecks that are finally going to pass and goods shortages that are finally going to ease. But here's the other key takeaway on this. It gets a little bit wonky, so bear with me. The central bank, once it begins raising rates, Chair Powell also saying it's going to start to reduce its balance sheet. That's a balance sheet that through the pandemic has ballooned to almost $9 trillion. Wall Street refers to this as quantitative tightening, and it adds another layer to this tightening cycle. It's also going to put some upward pressure on bond yields and interest rates.
So a lot of our viewers are concerned about inflation. Prices are top of mind for them, but they might not fully understand what interest rate hikes actually mean for them. Could you kind of walk us through, as simply as possible, how a future rate hike affects both consumer prices and things like consumer loans?
That's right. I mean, I don't think there's anybody right now, and by the way, not just Americans, but the world over, who hasn't experienced price spikes in some form or fashion over the past year plus. Here's the key question, because central bankers are now walking this very, very narrow tightrope. You have this battle against inflation, which is now at a 40-year high. So they're going to tighten the monetary supply. That's going to raise interest rates, which historically has always been the tool used to do that. But when consumers and businesses are already navigating this skyrocketing prices, you think cars, food, gas, rent, what happens when borrowing costs go up as well? So when I say borrowing costs, I mean the interest you pay on the mortgage or the auto loan that you're looking to take out, or the credit cards that you're paying down, or maybe those student loans, because the interest rates are pegged to the Treasury market and the policy set forth by the Fed. So this is where it gets really tricky, because if the Fed raises rates to counter spiking costs, how do they do that without denting consumer or business demand and thus triggering a recession? And then how do you do it with a pandemic layered on top of all of this as well? These are the tough questions that are being grappled with right now.
Yeah, we're going to be paying attention to the Fed a whole lot this year, I think, to see which way this one goes. Morgan, we got to talk about the markets because, oh, my gosh. All right. Yeah. For people who have not been watching them all day long, the markets were up all day today. We got the Fed announcement. The Dow went a little bit higher, and now all three indexes are in the red. It's been a roller coaster week, to say the least. Let's talk about what rate hikes do to stocks and what the markets are liking and not liking at all right now. It's been hard to put a finger on it.
It has been a whipsaw week, to say the least. I think the short answer here is that rate hikes tend to put pressure on stocks. That's especially true for tech stocks, which tend to be fast growing, not very profitable. When you see rates rise, that increases borrowing costs. It chips away at those growth prospects and thus the returns in those stocks. As you mentioned, it's been a wild week for the markets in general. We saw pretty steep losses. We came back from those to start the week. Today was the opposite. We actually started with the major averages, the Dow Jones Industrial Average, the S&P 500, the NASDAQ Composite, solidly posting gains this morning. But as Fed Chair Powell continues in this press conference and we get more detail around the Fed's policy moves, you're seeing everything trade lower now. And, of course, in the Treasury market, the bond market, interest rates are going up in anticipation of what's coming next.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.